Hey everybody, this is Jose. We are about to get started in just a moment. Here we go. Yes, I'm just looking at the time. Yes, let's have a quick sound check as we always do before we start the session. Please, let's go ahead and type a quick message in the chat box so I know you hear me. And that way I know sound technology is on our side and we are ready to start on time. Mark, good to see you, my friend. Mario, good to see you as well. Very nice. Miral, how are you as well? Yeah, I see your comment there about PayPal, Apply Material, and Futu, Miral. So we'll take a look at that during the session if that's okay. Wonderful, perfect. So time to get started. Let me highlight the disclaimer so you can read it. This is important information, so please read it carefully and completely. It is indeed important. Good to see you, everybody. Thank you, guys, for confirming sound is good. Ahmed, how are you, my friend? Very nice. So let's begin. The session for today, as always, the structure of the session, we'll look at the market first. From there, we'll look at reviewing the trades that we are running. We'll talk about trade management, and from there, we'll look at new trading opportunities, okay? Very good. So let's go ahead and close the introduction slide so I can point at tradewithufos.com/Jose, which is the page where you come to find the question section. Okay, it's the ideal place for you to post your questions or read your answers because many questions that you may have already been posted by prior members of the community. So search if you have a question, you may have the answer waiting for you. And if not, just make sure you log in. So you click on the purple button, you log in. And once you have logged in, you can then click on the green button to ask a question and you can just explain it, attach screenshots of the charts, whatever it is, and just phrase whatever question, concern, or share a thought if you have as well. Ahmed, yes, you're absolutely right. Before we get busy, Happy New Year, everybody. Absolutely. And for the ones of you that may not be able to stay until the end of the session, so Happy New Year, everybody. And Christian, good to see you as well. Very nice. Good. So let's jump into the platform and here is top and let's begin with our market analysis. Okay, so where are we at when it comes to market analysis? Okay, well, if we look at the climate on a daily time frame, we are now in a confirmed climate. It's been 5 candles into this climate, and statistics suggest the duration of the candle should be 6. So in other words, we are just doing something which is normal and expected, nothing that is not that normal. Many comments recently, a couple of days ago, when the market started making all-time high again, isn't it? But well, it's just a normal up climate progressing. Now, having said that, this up climate had a peak of progress right there where we reached the value of max distance of 1.46, where 2 standard deviations of that value in up climate is 0.74. So that is indeed a very, very powerful move, very what I would often refer to as too far too fast. And when something is too far too fast, typically it tends to not to be sustainable. Again, this is a very special time of the year as well because you got so you got so many traders and large fund managers and so on which are not participating of the market at this moment and basically just waiting for the new year to start and start trading again. So the volumes are not that high in many cases in many stocks, and whatever happens, it could be the product not of a lot of buying or a lot of selling, but actually lack of buying or lack of selling maybe what's driving what's happening now. So the fact that price had such an easy time to go up, it's probably given the fact that lack of volume allows for price to travel faster. Okay, and that's probably the case. So I'm not too concerned about the climate, but having said that, we are reaching the theoretical end of the climate, 5 out of 6. So we are closer to the end of the climate than the beginning. So in that sense, a note of caution. Positioning yourself to the long side makes a lot of sense. Over positioning yourself to the long side would not. because the climate is more likely going to end and change versus continuing. Now, if the climate changes, again, I'm not saying it's the end of the world. It's going to be a change for a couple of candles, like it happened the last time, and from there back up. Okay, for sure, down climates can also last longer, but statistics suggest that a normal thing to expect would be 2 days going down in the daily time frame. Okay. Uh, Talking about notes of caution, notice how the implied volatility for, I'm just pointing at the wrong candle, sorry for that. I'm like, that's not possible. Here we go. So the implied volatility for the calls is currently pointing at 1167, where the implied volatility for the puts is pointing at 12. What does that mean? It means that there is a little bit more put buying than call buying. And while the difference is very minor, which we could also see on the volume map, where 1.4 for the calls, 1.2 for the puts, 1.2 for the calls, it's not very clear. And beyond not being very clear, we are not reaching the average volume for the calls nor for the puts. The only place where I see this happening is for the puts here and here. So meaning that the put volume, it's kind of like winning, but it's nothing significant. And even when we look at the real time implied volatility for the calls and the puts, they are exactly trading at 13. Okay, both the call and the put exactly the same. So it's really lots of indecision, which also the shape of the candles says it. Okay, if you are a candlestick trader or you are a technical analyst, so those are indecision candles, isn't it? So we can also see that indecision in the world of derivative products and the prices of those options contracts. We can see that as well reflected there. So indecision, again, indecision is my least favorite in the sense that from there anything could happen. The market could just impulse up again or just reverse hard to the downside. So yeah, so you don't know what to expect after that. I mean, the only expectation we have here is that would be expected that probably the push is going to be to the downside because the climate is reaching its end. But we can certainly have another push to the upside and have an overextended climate. So again, at least if we had a little bit of a better understanding of what's happening with the options. So notice here with this very lengthy climate, the implied volatility for the calls was above the implied volatility of the puts, right? The blue line above the gray. But in this case, the gray line is above the blue, so you would expect it to fall, but it's so little that it's still difficult, and really we cannot say what's going to happen. Okay, so when it comes to looking for positions today, okay, if you were to build a portfolio from scratch, or if you just had closed a few trades yesterday or today and you need to add more positions to your account, so then my approach, given the market analysis I just went over, my approach would be to look for longs first, but immediately look for hedges to the short side. Why long first? Because the climate is blue, so we cannot negate that. This is the kind of like the most important thing, isn't it? So we cannot negate that. It's what it is. It's in front of us. It's obvious. It's, we see it, so we cannot just turn the back to it. So looking for longs would be my first choice. But because of what I mentioned, that the climate is reaching the end, the put seems to be winning versus the call by a little bit, but it is. So then I want to add a note of caution in the form of also looking for some shorts with less deltas, okay? Because we don't want the whole portfolio to be negative delta, but at least some negative deltas to offset if the market was to fall, to offset the problem that we generate on the long trades, okay? So we're going to be doing that during today and probably tomorrow as well in the session. Before we start looking, the VIX, I almost forgot the VIX. The VIX, obviously, with such a quiet market, the VIX is trading at 1745. So, very low VIX. Of course, the S&P keeps going higher, making all-time highs, so everything becomes calmer. There are less market participants in the market, so again, everything becomes calmer, okay? Not sure if you guys have ever, I'm sure many of you have, but for the ones of you that are newer to trading, so my question was going to be, not sure if any of you guys have been looking at what tends to happen on January 2nd, which is the first trading day of the year. This year is going to be January 3rd, isn't it? Because I believe, if I'm not mistaken, January 2nd is Sunday. So January 3rd is going to be the first trading day of the year. So typically that day you have a gap And often, which I don't mean to create any bias on any sort, we trade based on the rules, not based on biases, but often when you have a gap on the first trading day of the year, you have some sort of a continuation of that gap. So again, this has a lot to do with all those fund managers that went on vacation. They come back after the new year, first day of trading in the office, and now they are betting hard either to go long or to go short. That generates a gap, and often continuation because other fund managers, maybe the smaller ones, are looking at what the bigger ones have done and then, kind of mimic their action. And that often generates a little bit of a continuation. Okay. So we'll see what happens, and that for sure it's a fundamental or a cyclical type of pattern or reason for our climate, maybe to not to follow statistics. Okay, and maybe next thing you know, we're gonna have a 20-day going up straight non-stop because January 3, all market or fund managers, are gonna be like, that's it, we're going to the moon, right? And everybody's buying crazy. So we'll see that. We cannot predict the future, but certainly we can manage our risk, and that's our job, by entering longs, but also entering some shorts as a hedge, given the risk of reaching the end of the climate. Okay, so that's going to be the plan. A little bit of a summary of what I said with different words a couple of times. So that was a little bit of a summary, so it's clear for everyone. Questions, comments on what I just said, concerns you may have, please go ahead and let me know. I have a question here from Miral, requesting me to look at PayPal, Applied Materials, Futu, which I'll do after we review the trades. But also, while I am not a financial advisor and these sessions are not about providing financial advice, certainly I would understand that you guys may have some positions in your accounts, you are concerned, or you have thoughts about whatever it is concerning the new year and the trading into 2022. And if you have questions or you want to consult anything, again, feel free to phrase it. Those are today and tomorrow are very special sessions, in the sense that in one hand we're going to do the same thing we do all the time, because trading is not supposed to be special. It's about following rules, and in a way it's a boring thing to be done if you do right. But in the other hand, it is a special time of the year, because these are our last two sessions in 2021. So you may have different questions than normal, and I just want you to know, guys, that I'm here for you. And if anyone has a question, just feel free to type it on the chat box, and I'll be happy to comment and analyze for you. So, reviewing the trades, we have COF, okay? And COF is a trade that really we don't have too much new to add to what we saw last week. So that stock is a little bit of a teaser. Today is up by 0.03%. So that stock is going up, is going down, went down very heavily, and then up very heavily, basically to where it started, which is where the UFO is. So again, that UFO is likely going to push it back down. So if I keep analyzing that stock, I'm just going to repeat exactly the same I said last week. So I won't do that. I'll keep going, because we are in a safe position here with COF. Worst case is that we're going to make money. Of course, ideally, it's going to rally hard all the way to 179, and then we're going to make so much more. Yelp. Okay, so Yelp is a stock that is little by little, very slowly, but little by little, coming back to us. Okay, so if we look at the intraday time frame right here, so if I zoom out a bit more, so this crossover here, it's when we entered. So we entered at 38 point something. The stock went against us very badly all the way to 33 something. That was a big move against us. So we acted on it by butterflying it. Now it seems to be coming back a little bit. Elliott wave turning point here, that may help for this to keep going higher. And it seems that we potentially may approach what our entry was after a while. Okay. So now, in any case, we're using February expressions here. And while this trade is not looking good, when we look at the risk graph, we can see that risk is under control. We managed to reduce the risk. The worst case for this trade, as we know from prior sessions. Okay, sorry. Here we go. It's $300. Okay, that's the worst case for the trade if the stock goes down. But if that stock rallies just a bit more, like around 38, so then we're gonna start being in a profitable zone. Okay, and 38 really is $1 away from where we are. The current stock is trading at 37.05. So if we do have a little bit of an extra push to the upside, we may end up being in a profitable territory at that moment in time. Okay, Christian, haven't you see when everyone top is crashing each time I try using it? You aware? That's not happening to me, Christian. So I am not aware. But it would be good if you could send a copy of your page file to the support team so we can analyze if there is anything corrupted in there or what may the cause be. Okay, so please do that, and we will circulate that to our support team to try to help you efficiently. I mean, silly for me to say because I know you know computers, but have you rebooted your machine? Things like that. Okay, so just keep those things in mind because maybe something got stuck in your machine and that's the reason. But if not, send us the page file if that's possible for you, and we will analyze what's happening. Okay, so Starbucks. Okay, Starbucks is the next trade for us to review since there is nothing else to be done on Yelp, just but waiting. So when looking at Starbucks, actually this trade concluded last week when we were in the session on Thursday, isn't it? Even though the official closing time of the day was later in the day, but here is where price closed within the purple area, and therefore the Starbucks trade that concluded on December 23 was a full profit, and in that sense that's it. Okay, so the trade is over, nothing else to comment. And then finally, the last one we're gonna comment on today is the one we entered last week, which is working in our favor nicely. That's PHM. And when I look at PHM, let me get back to here. Well, actually, we're gonna see it better if I do this. Let me float this window out of top. Okay, so here's where we are with PHM. Okay, we entered on this particular day on PHM, and that stock has been, that was on the 23rd of December, that was the last session that we had, and that stock has been rallying. Okay, and that stock is now approaching our target, which was located here at 59 something. Okay, that was our target. Okay, even though, wait a minute, I believe I said that because this was deep in the Elliott wave target zone, so we were going to be a bit more conservative and set the target to be 58.37. Okay, so we are getting very close to that target. The trade is looking good. Okay, the trade is looking good. So in that sense, we may reach the target at any moment in time. Let me do this. Okay, so this will be the target. So I would like to analyze this trade to see if there is anything that we can do to help the trade, either to remove risk or increase any of the parameters that could make this trade more efficient for us. So for that, I'm going to load the risk graph, as we always do. I am now looking at where we're at, okay, and as you can see, so if you were to close this trade at the midpoint, we are currently making $109 per contract on this trade. Our target is 58.3, somewhere here. So in other words, if we get to our target and that happens today, we're gonna make 119. Okay, we are currently making 109. So basically, we are at this moment in time almost reaching the maximum profitability of the trade. What I'm sensing here is that probably there's been a little bit of an increase in volatility in some of the units because we have a little bit of positive vega. So you would expect to be closer to the solid horizontal line, which is the maximum profit on expiration. You would expect that to happen a bit closer to expiration, which is January 21st. But we are already almost reaching already the max profitability in where our target will be. Okay, so if our target is 58.27, our maximum profitability is going to be there, and we are kind of already reaching that. So in one hand, my temptation would be to close the trade because while we haven't reached the target, the increasing volatility in some of the units paid us a bit extra thanks to the positive vega, and we are already reaching that level of profitability. I mean, maybe we are leaving on the table like $10 or something like that, but I'd have no problem to close this trade. Having said that, beyond closing the trade now, and that's it, is there anything else that we can do? Okay, and this is what I would like to analyze to see if there is a better choice to make this trade better than what it is. or we are just going to decide to close it. And if we decide to close it, we're just going to do it. Okay. Christian, on the weekly, a long-term Elliott wave pointing to 70. Got you. I understand. But remember, the setup of the trade, Christian, was based on other parameters, right? Such as the auto climate, such as. So when we scanned for this trade, we had other elements in our favor, and we were not looking at the weekly time frame. So while you could certainly have a trading plan where you are looking at additional time frames on top of the ones I use, there are many ways on how to trade, my friend. Okay, and it's all good as long as it makes sense and you follow the rules and you manage your emotions and you manage the risk. So the fact is that I was not looking at the weekly time frame, so I'm not gonna add that information on top of my plan because number one, it was not part of my plan, and number two, now I'm adding extra information which on top of that happens to be contradictory. And my friends, you need to know this. If you keep looking at charts, there is a moment in time where you will find contradictory information. Christian, I misunderstood what you meant. You meant that the Elliott wave turning point on the weekly time frame is to buy instead of to short. I thought it was to short. Sorry for that. I misunderstood. So I was going to say that if you had this contradictory information, but this is coming from a time frame which is not part of your plan, you just ignore it. Okay, because if you keep looking at timeframes, you will I promise you that you will end up finding contradictory information. Okay, because remember, our business is to run a business where we manage the risk while we expose ourselves to potential profits, knowing that we cannot know the future for sure, right? So if you keep looking, you will find contradictory information. It's unavoidable. Okay, so there is a moment in time where you need to draw the line in the sand and not to cross the line, which is what I do with my set of rules. Nothing wrong if your set of rules were also looking at other time frames. And by the way, nothing wrong that apart from looking for active trades the way I normally do, that you are also looking for longer term investment opportunities, such as what you are mentioning, Christian, with this Elliott wave weekly turning point, which could be a good opportunity. Okay, so let me manage this trade, without thinking of the weekly turning point, and then of course, more than happy to look at it as a separate market opportunity and discuss what I see there. Okay, very nice. So let's go for it. Okay, so what can we do here? Okay, so what I'm going to do is the following. So first of all, I'm just going to add the compare feature so we can compare the original trade with whatever it is I'm going to build here. And the first thing that I'm going to build here is a trade where, remember, we were selling a bull put spread. Those two puts are a bull put spread. We were selling a bull put spread in order to buy the call. Okay, what happens? The market went up, so those puts lost value. So the first thing, and by the way, those puts are the ones adding risk to the trade. They allowed me to pay for the call for free, but then the risk was the distance between strikes, right? So what if I was to get rid of those puts? Well, if I was to get rid of those puts, okay, I would now remove the risk of the trade. So what happens if I do that? So I was selling the 55 put. So what if I buy it back? Okay, what if I buy back the 55 put? I was buying the 50 put. What if I sell it? Okay, in other words, what if I close my puts at the current price, which is midpoint? Okay, so if I click OK, this is going to show me what the net result of this trade would be, which is the orange line. And of course, now I'm left with a long call, which is the orange diagram is the diagram of a long call. But notice how, worst case, now I'm going to make $56.50, no matter what. Why? Because the closing price of the puts, if I was to close them now, okay, it's going to provide a profit. I sold them for 182.038. I can buy them back for 078, 015. So I make a profit on that. And therefore now, worst case, you would be in a $56 profit, even if the stock was to drop to zero. So certainly, that's for sure something I would do, which is to remove the risk of the trade. That's it. So no more risk, sure thing profit. And now if the stock rallies all the way, perfect. We participate at no risk. So that's for sure something I would like to do. But with that said, is there anything else I could do to make this better? Okay, so let's analyze our options. So I'm gonna add one more time the original trade. okay, because I want to leave the orange one in the middle because that one is a sure thing action that makes a lot of sense to make. But I want to analyze other choices. So I'm doing the same thing I was doing before. I'm just gonna, again, I said that's a sure thing I would like to do, right? So buy back the 55 put and sell the 50. So that's a sure thing that I would like to do. I'm not sure that makes sense to say a sure thing, but you got me. So so $59 now that would be the credit. I guess the stock went up just a little more and it's giving us a little bit more credit. But you know what else? Well, if I was to do that, okay, even though now we got 1, 2, 3, 4, and 5 rows, if you think about it, the 2 rows on top is when you sold the puts. The 2 rows below is when you close the puts and therefore the puts are gone from your account. So you are left with a long call. That's the only thing you have. So if I'm going to be left with a long call, my next choice would be, okay, what if I convert my long call and I make it a bull call spread? In other words, what if I sell a call against the call I have? So the call I have is the 60. Unfortunately, we only have $5 strike price increments, so I'm not sure this is going to work well. So above 60, I got 65. But I want to analyze that scenario. What if I sell the 65 call against the 60 call I own after I close the puts? Okay, after I close the puts, I only have one call. So what if I sell a call against the call I have and now I have a spread? So this is what the net result would be, okay, where you are flat, so no risk, okay. Worst case, you're gonna make $63.50, okay, and then your profit is being capped here, which you don't care because when you get to around 58 something, you're gonna get out for profit anyway, right? So worst case, you're gonna make 60 something instead of you can see here, worst case you're gonna make 64. In case of worst case, you make 56. Okay, so yeah, it's a little better, but the reality is that I wouldn't like to do that. Why? Because I'm only getting 7 cents by selling the 65 call, and the problem is that again, those options are very far from each other. From the 60 call, I need to go all the way to the 65, and then that's not really helping me too much. Okay, so what about the next action? And Joe, you are absolutely right. That's where I'm going, even though I'm going to give one more step in between so you guys understand the rationale on where I'm going and how I'm thinking. So when you do this by yourself, you can actually go through all the valid scenarios. Okay. So the other case would be, okay, well, if the bull call spread doesn't work well, okay, remember the bull call spread is sell a call, okay, and buy a call below. That's a bull call spread. So if that doesn't work well, another option would be this. Okay, so we have a call. That's the 60 call. Let's sell 2 of the 65, and let's buy 1 of the 70. Now you have a directional butterfly. Okay, now you have a directional butterfly, and that may work well, even though I'm going to tell you it's not going to work well. In a moment, you're going to see that, and you will see why. But that will be a valid action that we have done many times. When a bull call spread is not working well for us, what do? We butterfly it. So in this case, I don't have a bull call spread, but if I enter the bull call spread, it's not the best in the world. So I can butterfly it from the beginning, and hopefully it will give me a little bit of a better outcome. So I'm going to sell 2 of the 65, and then I'm going to buy 1 of the 70. So in other words, don't get confused here. So we are long. After closing the puts, we are long the 60 call. We sell 2 of the 65. And that was a mistake. And we buy 1. I guess I didn't click correctly. Correct. And we buy 1 of the 70. Okay. So 60 call, 2 of the 65s. The 2 is here. And buy the 70. So that would be a butterfly. Okay. And again, I'm expecting this one not to work well. Okay. And you notice that basically you are in the same place. Worst case, you make 67. Okay. And why is that? Well, because yeah, you sell 2 instead of 1, but you're still getting 7 cents only. And then you need to buy the 70, and that's going to cost you 6. So the extra one you sold did nothing, did 1 cent extra. So it's not working well. Why? Well, because those strike price increments are too far away. And because they are too far away, so they are not helping, for the trade to perform the way we want it to perform. So what's my other choice? Well, that's when I'm coming to you now, Joe, which is, well, remember, the butterfly that I was going to build is like that, right? So you have the 60, sell 2 of the 65, and then buy the 70, okay? Well, that's the one I was going to build, which is the normal thing that you would do. What if it doesn't work too well? Then you can reverse it. What if I keep that one as the 60, and those are going to be the 55, and those are going to be the 50? So I butterfly it on the way down. Are you going to be like, what? But that's going to be bearish now. Well, no, it's not going to be bearish. Let me do it and you will understand why. So I'm going to do 2 of the 55 and 1 of the 50. And this one may work. I'm not 100% positive. We'll see, but that one may work better. So let's take a look. And it doesn't. It doesn't because, again, the problem is that the strike price increment is $5, and that's killing me. But it is better in the sense that my risk is limited, and now my reward, okay, can be up to that 400 mark, which, by reaching the target of 58, which is more or less here, you would make so much less. Okay, you will make, I believe we calculated 119, isn't it? So instead of 119, now you can make up to 400. So that's good. You're giving the trade a chance to perform better. But what's the problem? Instead of going from a risk-free trade, you would then end up with a trade where you could actually now lose 113 if the market was to either move against you, or January 3, the world is going crazy, the market is going to the moon, and next thing you know, now the market goes to 60 and above, and now you are losing money as well. Okay, so if the strike price increments were nearer, so we'd very likely be able to set it up differently. But it's not working well, and therefore we're going to have to give up on it. And the best choice that I am concluding after all that analysis, again, the more the strikes you have, typically the better you can do at tweaking your positions. In this case, $5 strike price increments in a $56 stock, that's pretty wide. And therefore, I have limited choices to improve the performance and the risk of this trade. And therefore, the choice I'm going to select is to close the trade now, to get out, and that's it. Okay, that's going to be my choice. I mean, you could certainly go ahead and go for the middle case, right? Which is, close the puts only and be left with a call. But realistically speaking, those calls will expire on January 21st. So you're giving up on half of the profits if you end up making $49, which is the maximum you would make now if you close the puts. I guess the stock went down just a little bit. So again, my choice here is let's close the trade now. Okay, that's going to be my choice. Any question, any comment? I'm just going to perform this action on closing this particular trade with PHM. Okay, I'm just going to select the 3 units here, right click, create a closing order to sell the combo. I'm gonna place 2 different orders because in cases like that, often TOS gets confused and gives me worse prices on the exit. So I'm just gonna place an order to close the bull put. I'm gonna do this at the midpoint, which is 63. So I'm closing the puts, and immediately I'm turning around and placing another order to close the call. Okay, at 45. Okay, so I'm using 2 separate orders instead of a combo order. Okay, I just got filled on the call. Got it. So I got 46 cents. That's good. Now I need the puts to be executed. Current midpoint is 60. So the market has moved a little. So let me move with the market. So I get my fill. I'm just gonna wait a little bit here and see if I get filled. Okay, but anyway, um, that's it. Okay, so this trade is over. I don't see any questions from you guys. Thank you for that comment, Christian. It's my pleasure to share all those insights. That's what makes options trading amazing, isn't it? I mean, there are many other reasons too, but definitely having the option to work with your trades, it's a great option to have, isn't it? Okay, let me try to push this trade to be closed. 63 is the midpoint. Okay, so I'm gonna try 2 cents less. Wait a minute, I'm doing this backwards. I am buying back, not selling it. So I need to go higher. Let me try 65. So silly of me. So let's see if I get filled. I'm going to leave it there for a little bit, okay? Joanne, good to see you. Yeah, that was a lot to take in, but if you think about it, in the end, it's really the same process I follow all the time. Going from using puts to pay for a call, and then unwinding the puts, so now you are free of risk. And now that you have a call only, now you can sell a call against the call you have, so you have a spread. And now, if that doesn't work well enough, you just butterfly it. Or if the spread goes against you later as a second step, you butterfly it. Okay, so if you think about it, it's really the same thing. Okay, it's really the same thing. So, but of course, every case is different. Some stocks got strike price increments of $1 at a time. Some stocks, like this stock, is $5 at a time. All of it. Anyway, so let's go ahead, and I had a suggestion here to look at PayPal. So let me do that. Okay, let me do that. So let me go ahead and look at PayPal. I also want to utilize on PayPal. I would like to utilize, here we go. I would like to find out more about the group. Okay, here we go. So let me bring this to here. Okay, so PayPal belongs to consumer financial services, and overall that sector is down. Okay, overall that sector is down. Now on the daily time frame, the climate is blue, but while it's blue, notice how those are thin dots, and therefore the climate is not confirmed. So from those two angles, being a buyer would not provide a statistical edge for us. And on top of that, we just got an Elliott wave turning point pointing at the downside. Okay, so when it comes to PayPal, Miral, this is for you, my friend. My analysis would be more about shorting that stock, but I will not do it now because the climate is still blue, it's not red. But if any, probably that's a wiser action to take instead of going long. And I may be totally wrong, because you never know. Maybe into January 3, this particular group, the consumer financial services, end up turning around and becoming very, very strong. So this could indeed happen. But based on the current information we have to assess the trade, you would be just having a guess that this may happen, because we have no evidence that's the case at all. Okay, so in this sense, I would suggest not to touch PayPal, because I am assuming, by reading between the lines of your question, that you are looking at being a buyer of PayPal. Please correct me if I'm wrong, Miral. Applied materials is the next one I would like to check. Christian, you would want me to explain the reverse butterfly? Okay, let me go ahead and look at those couple of stocks, and then I will do that. Okay, sorry, I read your message a bit late. So what do we have with this particular stock? Okay, so when we look at semiconductors, that particular stock does belong to an industry which is strong. Okay, so this is a strong grouping, and we are in an up climate. Okay, so that's a totally different story. Okay, we had an Elliott wave turning point not too long ago with a target located much higher, 169. So from that point of view, and again, Miral, I'd love to know more about, because I don't see additional comments from you, so I'm not sure if you are still in the session or not. I'd need you to confirm this, okay, for me to continue planning the trade. But I need to know a bit more as well about the time frames that you use, and exactly what's your goal with getting into this trade. Certainly, from a directional point of view, we can see that semiconductors and AMAT in particular look good for a long trade as long as you have a valid entry point. You have beautiful UFOs there on the right. Let me see. On the 55-minute time frame, we don't have UFOs on the right place. But when looking at the 89, let's see. Okay, so I'm just loading the data here. Yes, when looking at the 89, there is a UFO there at 156, 155 that coincides with the EMA. Okay, so that's not too bad. Now probability is 49%, so I will not take that. But I don't see your response, so I am assuming you're not with us in the session anymore. So I'm just gonna keep going unless you tell me the opposite is true. But basically, if you keep looking, I would say that probably you're gonna find the right UFOs in the right place by looking at other time frames, and that should be a trade that makes a lot of sense for you to plan and execute, assuming it, what I just said meets also with the rules of your plan. Okay, not looking bad, not with PayPal, but definitely Applied Materials is a different story. Okay, but again, I don't see your feedback, Miral, and therefore I'm just gonna keep going. Okay. So Christian, the reverse butterfly. Okay, so the reverse butterfly really is very simple. A butterfly is a butterfly. So no matter if you buy a call, sell two calls, buy a call, or, and this is gonna drive you crazy if you're not aware of this, or you buy a put, you sell two puts, and you buy a put, or you buy a call, you sell a call, and you sell a put, and then you buy a put. Okay, no matter what, your risk profile is going to be like that. So a butterfly is a butterfly. Okay, so no matter if it's a call butterfly, a put butterfly, or an arrow butterfly, which is the one on the right, your risk profile is going to be like that. And the maximum profit would be achieved where the midpoint of the range is, right? So in the prior case, we had a target around 58, if I'm not mistaken, right? But unfortunately, we only had strikes where either 55 or 60 or 65 or 70, right? So those were the strikes available. So, in a perfect world, you would have the 58, but it didn't exist, okay? And on top of that, we were already long the 60 call from the beginning. So then what? Well, we only had two choices. Sell the 65 and do a put and do a call butterfly, which is 60, 65, and 70. So that's one choice. Or instead of selling the 65, sell the 55, and then we did a butterfly that was 50, 55, and 60. Because we already had a 60. So that one I cannot touch it. And by the way, that one is a call. So then I cannot make it a put. Therefore, my choice was to work using those because I already had a call in the equation, okay, the 60 call. So then I was playing with, okay, so the below one is going to be my 60 call. And I do 60, 65, and 70, where the maximum profit would be 65, because the maximum profit would be the midpoint, which is where you sell the two units, which in this case is, again, 60, 65, and 70. Or the other choice was to use the 60 on the top, and then we do 60, and then 55, and then 50. And then the maximum profit would be located at 55, because the two I would sell in the middle would be 55, which is, by the way, closer to 58. So I was actually liking that one better. That's why I thought maybe we had a shot. But then unfortunately, because of the premiums received and the distance between strike, which was $5, so then in the end, the trade was not generating a risk-free setup. Actually, we were assuming risk, where there was an option to close the trade now and remove the risk. Okay, so that's basically the summary of what I've done before, Christian. Hopefully this helps to understand. We will, for sure, as you know, guys, we are building options curriculum like in a proper way and everything else. And, when all of that is finished, you guys will have proper training, proper materials, proper everything to understand the various strategies, understand what I just explained, for example, that a call butterfly and a put butterfly on the chart look the same. Okay. And for the ones of you that are thinking, how can that be? Let me show you. Okay. You take a, where is it? Long butterfly, okay, where you buy the 160, sell the 162.5, and sell the 165, right? So if I look at this one and I graph it, it's a triangle, right? But what if instead of calls, I do the same with puts? We just got filled on the put side, by the way. So what if I do the same with puts, right? So now here, orange is going to be all puts. Well, notice how the risk profile is the same, no matter if it's calls or puts. Blue is calls, orange is puts. It's exactly the same, okay? Now, what if I do the arrow butterfly, where I buy, let me add one more leg. Let me do it like that so it's very easy to understand. So I'm going to start call, and then put. Okay. So what if I buy the 165 and I sell the 162.5 call, and I sell the 162.5 put, and I buy the 160 put? Okay. Same strikes, 160, 162.5, 165. Okay. Here from upper to lower, 165 above with the call, 162.5 with the call and the put, sell, and then below 160 with the put, buy. If I click OK, look at the risk profile, exactly the same. Okay, so again, I remember this used to drive me crazy. It's like, how can that be possible? Let me do it again, right? Because it's different units, right? But in the end, when you start thinking about what if the stock is here or there on expiration, what happens to the intrinsic value, the extrinsic value, in the end, it's the same. Okay, I mean, computers do things better than humans, and plotting a graph is indeed done with no mistakes by a computer. So it's the same. Okay, so that's why in my approach I was thinking, okay, let's build a butterfly. I mean, I was limited by the fact that I have a call. So then I cannot use puts because I have a call. But then I could build my butterfly going up, or I could build my butterfly going down, and the maximum profitability would still be in the midpoint of that triangle. I would not know, Christian, what is a reverse butterfly. I would know what is a long or a short butterfly, but not a reverse one. I mean, there is plenty of terminology out there in options trading or in trading in general that sometimes not everybody knows everything. So maybe I don't know that term properly, but also I will tell you many people make up terms because it's easy to understand or easy to teach. But the technical term for a butterfly is a long butterfly or a short butterfly. In a long butterfly is when you buy 2 units in different strikes and you sell 2 units in the same strike. That's a long butterfly. If you do a short butterfly, which may be the one known as reverse, so if you do a short butterfly, that means that you buy 2 units and you sell, the 2 units you sell are at a different strike instead of the 2 units you sell are at the same strike. So of course now the risk profile is going to be inverted. So instead of making money on the midpoint, now you lose the money on the midpoint. Right? This is now when you lose the most money, and if the stock moves either up or down, now you make a little. Okay, so that may be seen or understood as a reverse butterfly. I could see many educators using the term reverse butterfly because most people trade the other butterfly. So this one is the reverse. At the same time, it's I would think again, and I apologize if I'm wrong, but in my years of trading options, I would not think that reverse butterfly is a term approved by the industry, by the options clearing firm or anything like that. While could make a lot of sense for an options conversation between options traders and say, hey, that's my butterfly, but I reversed it, so it's a reverse butterfly. So I get it, okay, but I don't think it's a technical term which is official. Okay, maybe that's the way to say it. Cool. Okay, so let's continue. Let's see if we can find a trade to the long side. I don't see any questions from you guys when it comes to trades for or trades or concerns when it comes to 2022. So I'm just gonna try to find a long trade. Absolutely, Christian. My pleasure, my friend. I mean, I love this. This is really what makes these sessions rich. In one hand, hopefully, I enrich the sessions by sharing what I do and how I do it and the tools. But in the end, if you keep watching me, you will see that I keep repeating what I do. Why? Because I am a mechanical trader. That's what it's supposed to be, right? So many times when you guys bring in questions or comments or your own experiences, you actually help so much to make these sessions richer. So I thank you, my friend. Thank you for that. Okay, so we are looking for long opportunities. So I'm going to start looking for top positive spread. I'm not going to look at volatility yet. We're going to be looking at strong long-term groups. We're going to be looking at, sorry, not this one, my list, which is here, very good. We're going to be looking at earnings excluded until the next 30 days. And then the settings I have for auto climate, okay, let's start being picky, are going to be early on the weekly, sensible on the daily, and ideally near the 9 EMA. So let's see if we got something. And we got one, we got NVIDIA. Okay, so let's go ahead and take a look at NVIDIA so we can see the chart. Here we go, perfect. So the climate is 4 out of 8. Okay, price is coming towards the EMA, is actually testing the EMA as we speak. Okay, so it's actually a perfect entry setup, assuming that we have a UFO. Do we? Just a few minutes ago, yes. Okay, so well, certainly nothing wrong with planning on this trade. Oh, wait a minute, not getting too excited there. 47%, that's not good enough. So what about the 89-minute time frame? I'll take a sip of water. Not good enough. So what about 144? Not good enough. What about 233? Mm-hmm. You own that stock, Christian. Got you. 37%. So yeah, so no good with the intraday time frames. Okay, let's take a look at the daily and beyond. So with the daily time frame, no UFO. With the 2-day, no UFO. With the 3-day, no UFO. So that's a shame because it's that UFO was really in a nice place. I mean, it's not exactly what you want to see. It's 293. The EMA is 297. But certainly, if another UFO forms around here, that would be great. But unfortunately, with 47%, we are not going to take it. Okay, so we're going to have to look at other opportunities. And what I'm going to do here is to uncheck near the 9 EMA. And now we have a few more. And because we have a few more, so now hopefully I'll be able to also identify the ones we have cheaper options. And that is Mosaic and Yum. So let's begin with, I'm going to start with Yum. Yeah, well, it's a bit too far from any entry. Got it. So what about, let me float the matrix. What about Mosaic? So with Mosaic, we are also a little far and also 41% probability. So that's not making me too happy. Okay, so since we have a few options, I'm in picky mode. There are many check marks I could uncheck, but indeed no rush to do so. So looking at below 2 standard deviations, we don't have, oh, sorry, I just clicked on the wrong one. This one. Okay, none. And then what about looking at the greatest decrease on the mean on the last 5 days? So that would also show us cheap options. Now we have a few more. We said UM is not going to be the case. What about UPS? So yeah, it's just a bit far from the EMA. Also, the puts are above the call. So no. What about Agilent Technology? The calls are above. That's good. We're a bit far from the EMA. That doesn't make me very happy. And then we have SPG, which that one is relatively close to the EMA. The calls are above the put. So I am more comfortable looking a bit deeper into this and try to find a setup. So we had an Elliott wave turning point. We are far from reaching the final target, so there is room for this to go. We're in a climate candle number 5, which is confirmed. Climate is supposed to last by 8. The maximum extension we got is 94, where 2 standard deviations is 179. So that market is not moving too far too fast. And the calls are winning versus the puts. So all of this is telling me that, these could certainly have a nice push to the upside at any moment in time and give us a beautiful trade. So I would like to position myself or find a setup to be able to take advantage of that. Now, in a perfect world, you find a green UFO lining up with the EMA at 155. With the 55-minute time frame, we don't have it. What about 89? You see 89. With 89, we don't have it. What about 144? We have it. Yes, that's a perfect UFO right there. Unfortunately, 43% is not acceptable. It's less than 50%, so we won't accept it. Those orders in that time frame, they get canceled too often. So they are orders, but they may get canceled, and therefore we don't feel it's reliable enough to put our money at risk. So looking at the 233-minute time frame, come on, Mr. Internet, give me the data. Thank you very much. So we got 51%. That's good. And we got 154.89. This is 155 something. I'm going to say good enough. Okay, I'm going to say good enough. And the reason why I'm going to say good enough is because if that market, which is currently trading at 158, drops and starts falling, the EMA that has the letter M as part of its name, which means moving, will move, and it will move down. So that value of 155 may end up pointing at 154 or 155 low, which is going to be close enough to this number. And therefore, I'm okay with relying on that UFO for the trade, given its probability and its location. So I'm good to do that. What's the problem? Well, the problem is that price is currently trading, like $3 above that at 158.63. So I either need to wait for the market to correct and get me an entry, or I could approach it the same way I have approached it with PHM, which we just closed for a profit. So let's see what's possible with SPG. Let's load an option chain and see what's available. So from expiration point of view, that stock, just like PHM, it's almost done on purpose, only provide monthly expiration date. Okay, so we may not have the most liquid stock in the world. Okay, but at the same time, because it's monthly and there are few expirations only, so liquidity should be okay. 965 to 980, 655 to 680. Not the best in the world, but definitely tradable. So I'm okay to look into this deeper with Simon Property Group. Okay. So now, for me to pick expiration date and everything else, I need to think of where's my target. Okay, where's my target? Okay, and here, obviously, that Elliott wave area is certainly catching my attention big time. I would like to plot a speed bump out of this area, which is showing that. And if we were to assume that Elliott wave, that wave is going to continue. So we would assume reaching that bottom portion around 178, let's call it 178.5, just to make it easy to remember. So if we're going to take a trade expecting this market to reach 178.5, somewhere here. So the question is, how long is it going to take to get there? And the strategy builder does a fantastic job at giving us an estimation for a date, which in this case is February 6. Okay, well, if February 6 is the date where we assume that we're going to reach that target, okay, February 6, and we saw on the option chain that the expirations available are February 18 or April 14, right? So it seems that it makes a lot of sense to focus on February 18, at least if I got March. So maybe I can check February and March, but in this case, I'm just gonna, focus on the 14. Okay. Looking at the MACD crossover on the 23rd for okay, got you. Thanks for sharing that additional note. So so what can we do? Okay, so what can we do? Well, again, it's all about relying on that UFO. I mean, apart from the climate, the strength of the sector, all those things that we said, but it's all about relying on that UFO. So if the market was to fall, 155 is the option I would like to sell. Okay, so let's sell the 155. Let me do that again. Let's sell the 155, not buy. Right now, if apart from doing that, we were to buy an option below, now we are creating a spread. Okay, now we are creating a spread, which is providing $1.70 of credit. Okay, sell the 155 in February, buy the 150 in February, you provide 170, meaning now I have $170 to buy a call. Okay, $170 to buy a call. We said our target is going to be 178. So ideally, the call I can buy, it's below 178. That would be ideal. And it seems that we may be able to get the 175 call. I could add a few more strikes here. Okay. But it seems that the 175 call, we may need to pay 175. That was up to $2. Okay. So if that's the case, so that trade would cost me 22 cents. It's almost free, but it's not. Okay. So it seems that if we really want to make it free, we will need to buy the 180, which the problem attached to buying the 180 is that if you buy the 180, good news, you're going to have a credit, so you're going to have less risk. But bad news, you're going to have less delta. Okay, so I want to compare both. Again, my goal was to make this free or a credit. This is not a free or a credit. It's a debit of 22, so it's not super ideal. But maybe we can deal with it if the next combination is not as good. I'm just looking at the time. We just hit the top of the hour. So let's complete this trade. So if instead of 175, I was to do 180. Okay. So notice that instead of 27 cents of debit, you would have a credit of 48. So what's the difference? Okay. Well, one of the trades provides you with a risk of 527, where the other trade provides you with a risk of 452 per contract. Okay, so it's the same risk per contract. Okay, now what if we reach our target on February 6? Right, our target was 178 something, so 178.5 right there. Okay, so if we reach that on February 6, the second version of the trade will provide $384, where the first version of the trade will provide $573. Okay, so it's much more performance given the amount of deltas. Okay, the 22 cents gives you 29 deltas. The credit trade gives you 22. Okay, and overall, as the stock is moving up, the gamma is increasing the delta at a faster pace on the uppercase because the 175 call becomes in the money, right? Your target is 178, so the 175 call becomes in the money. That's the key. The one below, the 180 call, will be out of the money when you get to the target. So the delta will never pick up speed at the same speed. That's the problem. That's why the blue performs better. But you are now assuming a greater level of risk. Okay? So I'm not super happy. Okay? I'm not super happy about what I see, and therefore I want to try one more thing, which is what if I do two, okay? What if I do two of those? If I do two of the bull put spread, that's gonna pay me 320. If I pay 320, if I get paid 320, this allows me to buy the 170 call, okay? Or I can still buy the 175. Let me see that. What if I do still buy the 175? So buy one of the 175 call. Okay, so that would give me a credit of 132, and I'm not gonna like it because then my risk is too much. Okay, my risk is gonna be $1,000 minus 132, which is 868, which is much more risk. Of course, the profitability is also more if I get to 178 something. Okay, on that date. So now instead of 370, instead of let me rephrase that. Instead of 607, I am making 765, which is more, but my risk is double, and 765 is not double 607. Okay, so it looks like the trade I like the best is the one above. Okay, this is the most balanced trade I can find. I'm not in love with it, and the reason is the fact that we got $5 of strike price increments. That always makes it more difficult when it comes to picking the strikes that you want to use. But that's what we have available. So this is the best combination. Now, given the fact that this is a very little credit, I would suggest that we don't take the trade today. I'm just gonna keep it here, and tomorrow we will reassess this trade. And if tomorrow that stock, which is showing a lot of indecision at the moment, if that stock was just to drop a bit, we actually may be able to do this trade for a credit or flat, no cost. And that's going to give us a little bit of an extra advantage on profitability and risk. And therefore, I would propose, given the fact that we have a disadvantage with those $5 strike price increments, I would propose just to wait patiently to see if we have a little bit of a retracement and then just get into a trade. We don't need to wait for that stock to drop all the way to the UFO. I mean, that would be perfect, but we may miss the trade. But just dropping a bit would be good enough, which again is very likely going to happen because we got a red UFO there, right? So we may see some reaction going down, and we can benefit from that. So please monitor this into today. And by the way, you can also place an order. Maybe we can do that. Okay, so we can do an order, which is 160. I would not welcome that, Ahmed, because this is outside the UFO. So then you are not relying on the UFO. You're just adjusting your risk and deltas, which again is not something that is not smart. But if you were to, on top of that, align it with the UFOs, now you have a better protection. Okay, so let's go ahead and do this trade with SPG. Yeah, that's not an issue because we're in an up climate, okay, Christian? And in an up climate, sell on-field orders tend to be canceled. So, yeah, in that sense, not a major issue. In a perfect world, you don't have them. But again, you always have contradictory information when you plan a trade. So it's a matter of understanding what is hurting the odds of the trade and what is hurting less and what is helping the odds of the trade and what is helping more. And therefore, have a balanced decision about that, okay? So 155, 150. So we are selling that, buying that, and then we are buying the 175. So if we do that, it's a debit of 24. So I just want to do it for free, okay? Just to be a bit extra cautious, I want a credit of 5, Okay, so that's going to be the trade I'm going to place. I'm going to use a day order. So if I don't get filled, again, we'll revisit this tomorrow, so I'm fine. So that's going to be the trade I'm going to place. Okay, so February expiration, buying the 175 call, selling the 155 put, buying the 150 put for a credit of 5, which I will only get filled if the market falls. If the market falls, the put gain value, the call loses value. So now we move from a debit to a credit. If the market rallies, we won't get filled. We'll assess that tomorrow. Okay, so I'm just going to place the order here. And my friends, that is it for today. The trade is in, and I will see you tomorrow for the last session of the year. My friends, very good. Thank you for joining me today as always. And again, looking forward for that session tomorrow and continuing with everything we do. Take care, my friends. See you tomorrow. Bye-bye.